Hello everyone, welcome to IGCSE Accounting. Today we will talk about the bank reconciliation with the subtopic of automated transactions. In the previous video, we explained quite a little bit of the reason why we need to do bank reconciliation. Part of it actually is because of the automated transaction, which is not through the company itself, but actually being automated. Let's have a look of some of the example here. For example, the first one, credit transfer, that we want to talk about, the definition of this is automated payment of money into the bank account. In Malaysia, we also name as online transfer. So sometimes the company, they will make some payment to the suppliers through online transfer. So this is what we call in credit transfer in the textbook. All right. Another one is direct debits, a regular automated payment of varying amount made from the bank account, the company bank account, usually for utilities bills, and there are some like, for example, in personal point of view, like example that maybe make more sense to you, like your credit card outstanding that you would like to automate it so that you won't miss the time, the deadline, and there is then the value of it it will be various because each month your outstanding will be different. In company level, there is also credit cards, and also the electricity bills every month it will be different, right? And you maybe want to automate it so that you don't miss the outstanding problem. That means you own the electricity bill from the company. And so the other one is called standing orders, a regular automated payment of a fixed amount made from the bank account, the company bank account. This is more like rental. That is more applicable for this case. All right. And then here I do a comparison of these three things: credit transfer, direct debit, and also standing order. For credit transfer, normally it's not regular payment. It's one time of payments. For example, you pay to your supplier, and direct debits, the amount, it will be varies from month to month. Okay, and like standing order, yes, is regular, maybe monthly. And it's a fixed amount, like for example, your gym, your membership, that is a fixed amount. So normally we pay with a standing order. And the second thing that we can compare is sender or receiver. For credit transfer, sender, that means a payer. You are the one paying, is the one control the amount, control when to pay. But for direct debit, actually is receiver. For example, the bank, the credit card company, for example, the water bill, the water company, each month when there is an outstanding, they will directly bill you accordingly. So receiver, or maybe your phone bill, the company phone bill, the telecom, the telco, they will charge you directly from your bank account or credit cards. All right, and then the standing order is a sender, which is the payer control. For example, you are paying your rental to your landlord, then it's using standing order. Is it a fixed amount? For credit transfer, no, it's not a fixed amount. And then direct debit, also not fixed amount, but standing order normally is a fixed amount, right? And all these things you can set up in the online banking portal. Okay, update the cash book. So you see, once you have all these type of automated transactions or in the online banking, maybe you will miss it from month to month. So there is a process for the company bookkeeper or accounting department to update accordingly. So the definition of this is a cash book brought out to date by the business by the addition of automated transactions and other transactions the business has yet to enter into the cash book. Okay, so this is a process of doing so. And during your update to the cash book, there are a few things that you might find extra, the things that you found in the bank statements. Okay, the first one is bank charges. Banks usually charge businesses for the services they provide. These include regular charges, for example, for depositing the cash and check, and penalty charges, for example, for exceeding the agreed overdraft limit. So all this is bank charges. Some companies, they apply credit card, and then credit cards may be in Malaysia. Every year there will be charges, so we can treat it as a bank charges also. All right, another things that you might find in the bank statement is interest paid. Definition is borrowing from the bank. For example, loan and overdraft will means that the business is charged the interest. This is based on the interest rate and also the amount borrowed. Interest on overdrafts is paid addition to the fees charged by the bank for the use of an overdraft facility. But it's not saying that all the bank account will have this kind of overdraft facility. This is something that to share. All right. Another thing, interest received. Some banks pay interest on money kept in a bank account. But just a side note, it's not all the bank provides interest for commercial account. All right, this is based on the balance in the bank account as well as the interest rate. The interest is more likely to be received from balance in saving account rather than the main bank account of the business. Okay, the other one is dividends. Dividends are paid to those holding shares in other companies, and this may be directly paid into the bank account. So there are some company, they are buying other companies' shares. So that company, for example, you are buying another ABC Berhad company's shares, and then every time when they have dividends, it will actually automatic debit into your bank account. So it won't be informing you. So your account maybe miss it. That's why you need to do bank reconciliation. Okay, that's all for today's video. And if any question, you can put in the comment. And that's all. I see you in the next video. Thank you. Bye.